perhaps Nvidia isn't as strong as the market is currently perceiving, which I think, judging from today's price action in the early hours of trade, the S&P is not looking too great.
Is this kind of the end of the bull run in the S&P?
Mm-hmm.
Now, we've just discussed how Donald Trump and his policies are great for volatility. Where does that leave us?
I think the S&P 500 is actually very much a geopolitical tool these days to entrench the dollar.
Hello and welcome to the Market Edge. This week we're looking at the S&P 500, which of course has been soaring, but at the moment, not so much. Have we seen the start of the equity market collapse?
Inflation, interest rates, and sort of the potential for a recession. Are investors identifying the warning signs?
We'll look at corporate earnings. The corporates are in. We've seen some crushing it, but some other companies really struggling. We'll break down the risks, what's been happening, and where the smart money is going.
So is it the time to take profits, or should we wait for further upside? Stick with us, because this could define your portfolio over the next couple of months.
Do us a favor, like and subscribe however you're watching, on whatever platform you're watching on. Subscribe on any podcast platform to be updated every 2 weeks on exactly what's going on in these markets.
Right then, let's have a look at our wins and losses from the past few weeks.
But first, let's start off with the meme of the week. Now, this week, the meme of the week just shows what's going on in these markets at the moment. We've got it's a picture of Atlas holding up a planet, the Greek god Atlas holding up a planet. The planet says the entire global economy, and Atlas holding it up is basically Nvidia holding up the market. Now, we've known this for the Mag 7 companies anyway for quite a long time, and even before that, the FANG stocks, and probably this goes back for quite a long time, but not unrealistic to say that Nvidia basically props up the entire economy, is it?
Well, no, its share price move has just been insane over the last couple of years. And if you take that, AI narrative generally, that has been the strongest narrative over the last maybe 2 years, I would say, out in terms of factors and, upcoming tech. So Nvidia has been one of the dominant companies within that. But something that I noticed recently, we'll probably, develop this idea a little bit more as we get through the podcast, is that semiconductors have been a little bit weak. And so my thinking is that perhaps Nvidia isn't as strong as, the market is currently perceiving, which I think, judging from today's price action in the early hours of trade, the S&P is not looking too great.
Yeah, I mean, this is an interesting one, isn't it? Because you've got, just touching on what we've got going on with the Russia-Ukraine peace talks between the US and Russia, which makes so much sense. But they're obviously talking about the US doing a deal for the natural resources in Ukraine. Now, a lot of those natural resources are these minerals that go into semiconductors, right? But that's all well and good. If the demand's dropping off, like is the potential, because we're seeing a lot of rumblings that demand for semiconductors and in this sort of area in general is dropping a little bit, puts that deal seems a bit of a weird one on the table there.
Yeah, it's probably quite cyclical though.
Yeah.
So AI is not going anywhere really, but
No.
I think there's probably been a lot of front loading of demand already.
Yeah.
The Nvidia order books were very full. I don't know the data on it now, but there was a hell of a lot of buying for like a year, 18 months out. And I guess there's only so much that you can do at one time until there's kind of a new reinvigoration of the economy.
Yeah.
So I think that's what we're seeing. It's very cyclical.
Yeah.
And, stocks like this where there's a really hyped narrative, not necessarily hyped, the demand is there.
Oh, it is hyped.
But it's probably overhyped in terms of some valuation,
Yeah.
of course. And so when you start to see that economic cycle soften a little bit, that's when you see these stocks come.
So there's going to be a lot of people getting twitchy, right? Now, and we'll probably move on to this, as you said. We're going to move on to this in the main crux of what we're talking about. But there's going to be a lot of people holding Nvidia, a lot of people who are getting twitchy about whether we dump that. And I suppose that's something. Hold on, we're going to talk about this in the next few minutes or so. But that's a big question at the moment, right? I'd say.
Yeah, definitely.
Okay, let's move to the tweet of the week. Now, this is interesting because last week, from when we're recording, there was two big bits of news that came out. There was Walmart earnings and there was the Fed meeting minutes. Now, this is Peter Schiff, notorious bear in the market, we'd say, right?
Yeah,
notorious bear, bit of a bear.
He's a gold bull, isn't he?
Yeah,
so they're always a little bit conspiratorial.
Gold bulls, conspiratorial,
and
bear on anything else.
To side note that though, he also owns a gold bullion firm and research firm. So there's going to be a little bit of bias.
There's definitely no...
there's no conflict of interest.
No conflict at all. Fine, yeah, excellent. But the tweet reads, Walmart's reduced guidance is a wake-up call that the savings-depleted, overly leveraged US consumer struggling to afford ever-rising prices isn't as strong as widely believed. The myth of the strong US economy will soon be exposed and the reality of stagflation laid bare. Pretty punchy, pretty negative. I think most people, even in the UK or around the world, can feel that, the consumer is struggling in a lot of places. But just going back to what we said, last week Walmart came out and spoke about their earnings, but it was their forward guidance that was the killer. And that was because the economy, their fears about the economy. Now, the Fed also came out in their meeting minutes and said that because of the tariffs and the foreign policy put over by the new administration, don't expect any more rate cuts for the foreseeable future because we don't know what's going to go on with the economy. Now, Donald Trump's come into power, and again, we're going to touch on this in a little bit, but the market's under pressure ever since then.
I think I said this on the podcast just after he came in with our podcast. You can probably go back.
Podcast that we do.
A podcast, around one.
Someone does a podcast around here. You should probably search it.
But basically what I said was he is good for traders, but not good for markets /
So volatility.
Investors. Yeah, traders want volatility. Traders love volatility, but investors will really, really find, I think, up until August, maybe September, where, when I was broken back in 2017, that's when he was releasing all of the China tariff tape bombs. And one of the things is that the market finally digested all of his tweets and all of the random, bits to do with China trade that would come out in terms of policy. And then it didn't matter so much. But it took a fairly long time, about 8 or 9 months, for the market to say, okay, we kind of understand that it's not going to be that big a deal now. Yeah. And so I think it's going to lead up into, Q4 of this year until we really, really get that. But
so is it likely to be the same story then?
I think so. It's obviously not focused towards China. It's more just a volatility question.
Yeah.
The market's again trying to get used to Trump more than the specifics of.
But then I find this strange, right? Because we're trying to get used to Trump, but Trump's come in doing exactly what he did last time. This is like a carbon copy of what he did last time.
You have to remember, markets are completely ADHD.
Yeah.
They're very ADHD. I think. If you think about even how maybe algos are programmed, they get used to a certain regime, and then when that regime changes, things have to change in terms of how the algos are working. It's just one example. It's not exactly it. But at the end of the day, it's going to reflect something different in how asset prices move. And we will probably come on to a couple of reasons why as well. But in terms of this view about the US consumer, right now, if you look at which ETFs are really, really performing well, actually consumer discretionary is performing very, very well.
Yeah.
Alongside growth, which naturally is a bit of a tricky one with Nvidia potentially falling, the S&P falling now.
Yeah.
So it doesn't necessarily reflect that the US consumer is weak. What I think is happening is that we're reflecting a global market cycle change. And that's really what's happening. And the thing with the US is that, Euro Stoxx 50 is at all-time highs and has been the strongest performing ETF of the last 3 months. Now, why is that? Alleviation of the Ukraine situation, but also the dominance of the US consumer within German, French, Spanish companies, because the US consumer is so strong. So the US consumer is actually...
Is it the US consumer being so strong, or is it the US consumer being stronger than the European consumer?
No, it's because the US consumer buys so much from those companies. So they're propping up their revenues, basically. So I guess it's the US consumer and obviously include, US businesses and whatever in there. But the DAX is dominated by about 60% of US sales now. the CAC as well is very, very similar.
Which is good because the German economy is absolutely screwed.
Oh yeah, the Germans don't buy anything from their own companies anymore. It's insane.
Yeah.
And so I think he might be getting a bit of a correlation versus causation issue, but I don't necessarily disagree with him on the stagflation laid bare, because I think it's a global cycle change more than anything.
Yeah, for sure. Now, I mean, we'll come on to we're going to come on to this. Don't worry, we're going to get far more negative in the next 20 minutes or so. Let's look at our picks of the week from last week or a couple of weeks ago. We had Porsche and $CAD. Start off with Porsche.
Porsche has picked up off of its low because basically the bet was that, you know, Porsche moving back to combustible engines is more like their traditional business. And we've seen what the share price has done when they've pushed to electric.
Yeah.
So it's basically like a reversion of that. You know, traders will be thinking, oh, right, they've changed something. Maybe we should buy it now. That's literally what goes through their heads. I mean, that's why I bought it, and that's why a lot of people that I know bought it as well.
And plus, this is a stock play, right? It's not. I know we're looking 2 weeks. You know, you're very rarely buying stocks for a couple of weeks, right?
Yeah, exactly. You know, I'd hold this for a longer period, let their business plan play out, and see what happens.
And the other one was $CAD, and $CAD obviously was on the back of tariffs. We'd seen quite a big move there. Actually, it's done very little, to be perfectly honest.
Yeah.
And it's been a weird one because we've seen so much in the way of news flow coming across in all tariff side. All of these leaders are involved in the NATO talks, the Ukraine talks, and actually $CAD and a lot of currencies haven't actually done that much.
Well, the thing that I always note whenever I see something like that, where you see loads of news flow, and not much movement, is that volatility contraction eventually will lead to a much broader expansion.
But it's like the spring being compressed, isn't it?
Yeah.
So that's what you get, and that's, you know, that it's definitely a phenomenon in the market. You get massive amounts of news flow, which was Trump always brings, right? And the markets go like that, and there's a concentration of people having, or traders or whatever it may be, having a view one way, waiting for. So the
best strategy to look at here, and this is what I always do. This is predominantly my the way I trade FX these days, because the volatility just isn't there. Is when you do start seeing a range like that form, go on to any large broker's positioning and see if there's stretched position in one way. I normally go for 65% and above. So if there's, you know, I don't know, let's say there's 65% of the book long on $CAD, I would start to look to get short, because what you've got to consider is, unfortunately, retail participants are considered as uninformed. And so what that means is that, you know, the broker's model is that a lot of the time they want the client to lose because then they make money. And so if you're going the other way, you're basically trading with the informed flow. So if you see, you know, on any pair, $CAD could be one. I don't actually know what the sentiment's indicating, but if it's very, very stretched one way, go the other way.
No, and I think you get a lot of the time. You also get with a retail trader reluctance to go short. You do get a lot of that reluctance to go short. So even when there is a, now I'm not saying this is all retail clients, but you know, whenever there is this feeling, the overstretching always comes to the upside. You'll never, very rarely you'll see, especially within currencies, there's an overstretching of a sold position.
Yeah, I guess, you know, what needs to happen is just flip the currency quote round.
Yeah, exactly. Yeah.
If you're short $CAD, it means you're long CAD dollar.
Yeah, it's a great strategy though.
It is. Just turn your screen
long
around.
one, short the other.
There you go.
Exactly the same. Never lose any money.
Exactly.
Yeah. So this brings us on to our chart of the week, right? Yeah. So chart of the week is the S&P 500. So we're talking about fundamentally, and actually, we probably have to state that as we've come to film this morning, there's been a big move, right? Futures are pointing at markets being lower. Now, we don't know where markets are right now when you're watching this, but as we're sitting here, markets have fallen. The S&P's, after hitting record highs last week and quite consistently recently hitting record highs, the S&P has fallen, is aggressively lower, is below 6,000 in terms of futures pricing at the moment. Now, of course, caveat, we don't know where markets are, but this is quite big moves to the downside in something which has been aggressively going up. And just before we get into this, we've just had earnings, right? We've had earnings numbers. I want to reel off some of the data on this earnings. Why I've got a pad and a pen, actual
smart
pen,
yeah.
just to make myself. I could have tried to wear glasses as well to make myself look a little bit more intelligent. But anyway, so within earnings season, 78% of companies beat expectations. Now that's only slightly above the 5-year average, which is usually 77%, which I was surprised at. Over a 5-year average, this shows you how strong these companies are, right? But 78% of companies are beating expectations. Now, the average beat, this is the interesting point for me. The average beat on these companies was 4%. Now, usually, that's over double that. So it's usually 8.6%.
Definitely a slowdown.
So there's definitely a slowdown in that. Now, what we're seeing in terms of overall markets now and the S&P is this sell-off. Markets starting to come lower. Are we hitting this perfect storm? The question we ask in the title is, is this, kind of the end of the bull run in the S&P? Now, we just discussed how Donald Trump and his policies are great for volatility. Where does that leave us with this?
So in my opinion, if we're looking at some more statistics, if you look at price to book and price to earnings, we're at the highest numbers since actually the .com.
Yeah.
Which...
How did that end?
It didn't end too great, did it? But it's also fine because we're in a different context. There's more liquidity sloshing about.
Yeah.
And, we know that the Fed is going to, come and support markets pretty much at any real unraveling.
Yeah, they can't collapse.
No. And so, and on another point, I think the S&P 500 is actually very much a geopolitical tool these days to entrench the dollar. But we'll get onto that argument another day. But this chart here is one that's very, very key to me and not one that's highlighted very often. This is AAA credit spreads. And what you'll notice is that they started ticking up when Trump came into power. And what AAA credit spreads are is you take a basket of AAA corporate debt and the yield on those, and you find the difference between a treasury bond, a basket of treasury bond, and the average yield. That difference is basically the spread. Okay, that's what the delta is in anything financial. It's just a spread, right? So what we're seeing at the moment is this ticking up pretty, not aggressively.
So this is the spread widening between those two assets, right?
Yeah. So the closer that corporate debt is to treasury yields, the safer it is effectively. Yeah. The more expensive corporate debt gets, the more that people are perceiving risk in corporate debt, or if we want to say it more broadly, the more risk in companies is increasing. So that's what we've seen since Trump has come in. And so it's no surprise to me, after looking at this, that we're starting to see weakness broadly in the S&P now that we are approaching the previous pivot point sort of that we found in May last year. Yeah. If you see that, we've already ticked above it, but then we traded back below it.
Yes, it's kind of this 30.35 level, right? We can see.
Yes, exactly. Yeah. So now if we take this as a proxy for if you were to invert that chart, okay, if you were to invert that chart and overlay it with the S&P 500, it would look the same.
Similar, yeah.
And so what we're looking at here is really the, and if we consider that corporate debt is very much a institutional product, what we're seeing here is institutions start to price in some risks in companies. Whereas in equities, you get massive retail flow. And by the way, actually, from Valentine's Day and the 22 days preceding, there was the highest net inflows from retail into equities ever. Yeah. And if we go back to that,
this is that old adage of like, when you start hitting it down the pub, you should buy the S&P, sell it.
Yeah. And if we go back to what I was saying about positioning, that stretched positioning, hearing that retail has piled in every single day,
and it's more long than it's ever been,
and it's more long than ever. That gives you a sense of where the direction is going to go. Yeah. And for me, this is something that is really, really key, this chart, purely because it's identifying that 3 month now, or 3-4 month bottoming behavior in spreads, which are going to increase costs on corporate debt.
Yeah. So if I sit on the other side of this and say, what you're betting against is what? 10 years of solid upside?
What, previous upside?
Previous upside, yeah.
Yeah.
What we're betting against here is the S&P, playing devil's advocate in this, is the S&P has been strong, and we've seen downside like this before, right?
Yeah, I mean, we saw
which we could all go. Well, that's just to buy the dips, right?
Yeah.
And we've sat here and said, you look at 52-week highs on stocks, fair enough. But, if something's going up, buy things that are going up and to the right. Yeah. Well, the S&P's been going up and to the right. And, okay, it's dropped off a bit. But what do we say usually? Buying opportunity, buying the dips.
What are you going to say?
Why are we all of a sudden saying that's not the case?
The difference is there's two things that people start to get concerned with when it comes to trading the S&P.
Yeah.
It's selling, shorting, and buying. A lot of people don't realize the difference between selling and shorting.
Yeah.
And this isn't advice, but shorting the S&P is probably one of the least expected value activities you can do in your life. Selling it, fine, to rebuy a dip.
Yeah.
But there's two different things. If you're taking a directional play on the S&P 500 rather than a take profit play, they're completely different activities.
Yeah, so if you're shorting the S&P, just to clear it up, you're saying you expect the S&P to fall from here.
And you want to make money off of it.
And you want to make money on that downside.
Exactly, yeah.
Okay, let's move on to our pick of the week. We've got HSBC as one and Nokia as the other. So HSBC, obviously, banking strong. Do we just see banks being strong forever?
Well, I think the way that I see it is Fed cuts have been pushed back.
Yeah.
And with what that means is basically net interest margin for banks increases. That's basically how banks make profit. It's the difference between the cost of the loan and what they get paid back. And so if interest rates are higher, again, that spread differential between treasuries and whatever, that's going to be able to, finance them well. And so this is why financials are doing quite strongly at the moment. Yeah. And if we look at it from a technical perspective, it's above trend on everything. Yeah, nice three. If you're watching this, then you can see the chart is your perfect trend, isn't it? It's upside, moving averages all in a lovely little row. Exactly. Yeah. Nokia, a little bit different, but then Nokia, obviously, probably we can think about this as a bit of a weird one. People would go, well, why buy Nokia? No one's buying Nokia phones anymore. But they're not really just phones, right? Well, no, exactly. They do a lot of cloud stuff. Yeah, and I think this is the key thing, isn't it? It's cloud, because we've seen a similar move to this. Now, obviously, Nokia is traded in Finland, right? Not in the US. But we've seen a similar thing with BlackBerry. BlackBerry shares looking particularly positive, and again, there's a lot of cloud work going on there. Yeah, it's cloud data centers. Yeah. Loads of stuff that they're doing that's quite special. And the thing with Nokia is that they're a legacy company, and it's almost like they're entering into a new era. Yeah. They've gotten rid of the 3310s. Yeah. And now they are able to go into more higher tech solutions type of a business. Although I did read as well that there was that there's a generational shift. This whole smartphone generation is waning off. I don't necessarily believe this too much, but they do expect that generations coming from now will have less device time than the generation that we're currently sitting in. It's because they're all wimps. Yeah. Fair play. I think on that bombshell is quite a nice way to end. So thanks very much for listening. And I think the key thing this week is we've stated that the S&P is in trouble. That could mean wider equity markets. Do you agree? Do you think we're talking absolute crap? Let us know. Like and subscribe. Let us know what you think. But thanks for listening.